The topic for our discussion this morning is Forex profit with pivot points. My name is Raman Gill, and I am the founder of the website tradingwithvenus.com. In today's live session, in this webinar, we'll be looking at at pivot points, and we'll learn how to use pivot points to get directional bias in the Forex markets. We'll take a look at a simple pivot point trading strategy. Actually, we'll take a look at 2 or 3 different pivot point trading strategy that will help you earn more profits in your Forex trading. We will also learn how to properly implement this strategy to become a consistently profitable trader. I will touch on a step that most traders miss when learning new setups and how you can use this one step to cut your learning curve in half. Before we get started, just a quick disclaimer. This is for educational purposes only. If you have any questions about your individual investing needs, I suggest you talk to an investment advisor. Okay, so first of all, a little bit about myself. I'm a Forex trader. I have been trading live for the last 7 years. In terms of my background, I have 2 MBA degrees. I went to an Ivy League college in the US, Cornell University, and also from Queen's University in Canada. It was a joint program for the 2 universities, and I had to pass the qualifications for both of them to actually get my degree. Prior to that, I have a bachelor's in computer system. My previous experience has been in IT consulting. I run my own IT consulting company for over 10 years, and I have also a lot of experience in banking financial industry after that. Now, in terms of Forex trading, one of the questions that I always suggest everyone ask is, why do you want to trade Forex? Forex is a very exciting field. It is very interesting. There is a huge upside potential to it. However, you will never hear me say that you can make millions overnight, because that is just not true. You would not be able to make millions overnight unless you have a large account. However, it does have a lot of upside potential. So one thing that I would say is ask yourself the question, why do you want to trade Forex? If it's just for quick money, I would suggest that's not the best reason to get into this industry. It may seem from outside, it may seem that this is a great industry to get into. Lots of money can be made overnight. Everybody seems to be talking it up. However, you need to have something beyond just the focus on money to get into this. Money is always nice to have. It's nice to make money. And yes, you can make money in this, just like you can make money in working in a job. You can make money doing a lot of different things, having your own business and that sort of stuff. However, I suggest a larger reason for being there, because Forex is a field that does take hard work. So this is not a get rich quick thing. You have to learn. You have to put a lot of time and effort into learning. And having that reason for you to do that always helps accomplish your goals, because when you hit the tough times, you need to have a reason to get through the tough times. If you're just doing it just because it's fun or it seems interesting, you may not always have that drive to go through it. So I suggest maybe take a look at why you want to do this, and what do you see at the end of the road. For myself, I do it because I love trading. I'm so passionate about trading. I can talk about trading all day long, all night long. I will stay up late and talk about it. And some of my students have seen me do that, because I can just go on. And I love analyzing charts. I love looking at different fundamental events going on around the world. I like understanding supply and demand and that type of stuff. So I just I have this innate passion for Forex. Forex trading is for me like coming home. So just ask yourself that question, why are you trading? And another reason for me to trade is that I want to be able to provide for my family. I want my family to have a great future. I want to send my kids to private school. I want to give them everything they want in their lives. I want to drive nice cars, have nice house and stuff like that. And Forex trading helps me accomplish that. I have gone through a lot of ups and downs in trading. It took me a long time to become consistently profitable. Being profitable was easy. I was able to do that in the first year. However, being consistent was what took me a long time. And that's what sent me on this journey of trying to figure out, what does it take to be consistently profitable? In today's session, I will share some of that with you as well. It's learning all the hard lessons, some of the stuff that I will talk about, like the one step that I mentioned in the beginning, where this is something that most people tend to miss, because It's not that it's difficult, it's just that we don't have that innate desire to do it. So pay attention to what we talk about here today. And, I have learned things the hard way. So my goal here is to put things together in a way that's easily understandable. One of the things that I would say to you guys is just do it. Just try it out. Any strategy that you learn here today, try it out yourself, try it in a demo account and see how it goes. See if you're able to make profits from it. And if you have any questions, feel free to ask me. I'll ask you about questions in the end. Feel free to ask me those questions. And even later, send me an email or reach out to me, whether it's on Facebook or Skype or email, whatever avenue it is, reach out to me. I will help you. I am really passionate about trading. And lately I have found when I first started doing this educational side of it, it was just to have some support around myself. It's really isolating doing trading on your own, sitting at your computer and just trading. And I found it was the mind kind of plays tricks on you. You start seeing patterns where they don't exist. You start taking trades that are just bad trades, and you really mess yourself up because you're so isolated. I remember sitting in my downtown apartment before we had kids when we used to live downtown, and it would be snowing outside in the dead of winter in January, and there was like a foot of snow outside. Couldn't go anywhere. I was done with my trading. I had made nice profit that way that day. Actually, I think it was like $2,500 or something I had made in profit. And really, I just wanted to turn my computer off and go for a walk, but I couldn't go anywhere. And we were new to Toronto at the time, and I didn't have any friends in the city at the time, so I had nothing to do. It was so isolating. What I ended up doing was I just opened up my computer again and I started trading, and it was just bad choice. So I have gone through a lot of these things like that, some of the struggles that you may be facing. I have done that, and I ended up giving all my profits away just back to the brokers because I just didn't have anything else to do. So make sure when you're trading, you're not just trading on your computer all day long. You're not sitting in front of your screens. Once you've hit your profit targets, walk away, go do something else, enjoy your life. Really, trading should be to have fun in your life, to make other things in your life better, not just for the sake of sitting in front of your computer and keep giving your profits back to the broker. So that's just my little spiel before we get started. So for those of you who do not know what Forex is, let's start there. And I promise I just have one slide on what Forex is, and then we'll dive into the meat of it. So Forex is the largest traded market in the world. It has a $5 trillion daily turnover. And when you compare this to other things like equities markets, for example, New York Stock Exchange, which is one of the largest traded markets, you see in the New York Stock Exchange, the daily turnover is 50 billion, whereas compared this to the Forex market, it's 5 trillion. So it's not even in the ballpark. So it's a highly liquid market. And by that, what I mean is when you enter your trade in, your order in, it will get taken up. You wouldn't have to wait. When you're trading equities, for example, let's say you want to sell 1,000 shares, it will take some time to fill that order because somebody may not be on the other side of your trade right away to buy those from you. It may take you some time. However, if you were to sell 1,000 lots in Forex, you will be able to hit that. When you're trading 1,000 standard lots, which well, I don't personally trade myself, but that's just too large an amount. This is more for the financial institutions. However, even when they trade it, their orders are filled as well because it is a huge market. They may have to stagger it a bit because if they put in 1,000 standard lots tomorrow, the price may drop right away. However, there is always somebody on the other side of your trade. So if you're trading 1 to 5 lots or minis and micros, there will always be somebody on the other side of your trade. So it's a liquid market where you can execute your orders right away. It is also open 24 hours a day, so you can choose when you want to trade, whether that's the London session, New York session, which goes from 8:30 to about 5 o'clock Eastern time, or if you wanted to trade Asian market, you can trade that as well if you wanted to just trade at night. So you have a lot of flexibility as to when you want to trade and when you are engaged in this market. We also have the opportunity to use leverage in our trading. When you go into equities markets and you wanted to buy shares of a company, you may not be able to buy as many shares as you like because you just don't have the amount of money in your account to buy something. For example, let's say you wanted to buy something, a share that's selling at $100 a share, and you wanted to buy, you have $1,000, you can only buy 10 of those shares. However, if you go into Forex trading, let's say you have a $1,000 account, your broker will give you leverage so that you can trade larger size and you can make profit. I do not recommend trading standard lots on a $1,000 account because that's taking on way too much risk. That is not the right thing to do. You do need to manage your risk according to the size of your account you have. However, even if you are taking on a small leverage side, you still have that leverage. You're still able to trade more than you would be with your $1,000. So let's say you have $1,000 and without any leverage, you would only be able to trade 1 micro. However, in this case, you could trade with using leverage, you can trade minis and you can still make more profit and you'll be able to without using leverage. So that's the best thing that's available in this market. All right, so now let's get on to pivot points. So what are pivot points? Pivot points are used by professional Forex traders and market makers. These are used to identify potential support and resistance levels. These are also the areas at which the direction of price movement can possibly change. And we'll talk later on about how you can identify the directional bias in the market using pivot points. I will go over that later in the slides, but know that you can find the direction of the price movement using pivot points. These act as support and resistance points. And these are completely objective. This is a completely objective way of doing that. There's no discretion when you're using pivot points. And the reason for that is because pivot points are based on mathematical calculations. These are not, for example, Fibonacci levels. I like using Fibonacci levels as well. However, there is some discretion involved. When you, for example, do support and resistance levels, there's discretion involved in where exactly do you put your support and resistance levels. However, in terms of pivot points, there is no discretion. It's a mathematical formula that's calculated, and that's what it's based on. So it is completely objective. These are the levels that a lot of large financial institutions will use to work in the financial industry, and they use pivot points. Because they're so widely used, they're almost self-fulfilling. It's like a self-fulfilling prophecy. Because so many traders are paying attention to them, they actually end up working out, not because they're so special, it's just that because everybody's expecting them to react at those levels, the price ends up reacting at those levels. People put their buy and sell orders at that place. And because of that, it ends up being a self-fulfilling thing where price will go to a certain level and then it will hit orders in that area. There will be order blocks placed in there. And a lot of financial institutions tend to use this strategy. They'll place order blocks. Let's say if there's a M&A, mergers and acquisition activity coming in, and a trading desk receives a large order, they cannot just have all of that, the entire order go in one swoop. So what they'll do is they place it at separate different levels. So they'll have, for example, 100 lots at one point and 200 at another 50 at another level. So what market does is as these orders are hit, it creates price action in these areas. Our pivot points or pivot levels are areas that financial institutions will place their orders at. So these are levels, because they are respected by so many traders, they end up being self-fulfilling, just like Fibonacci levels. Fibonacci levels are self-fulfilling levels as well because so many traders respect them. All right, so let's move on to how do we use pivot points. So we can use these pivot points in 2 or 3 different ways. So the first one is for range-bound markets. You can use pivot points as a way to identify reversal points when the price is consolidating, when the market is holding a range. You can use pivot points as areas where the price will reverse from, and that's how you can use them. And we'll go and take a look at a range-bound market trading strategy using pivot points. You can also use these as a way of trading breakouts out of range. And we'll take a look at that strategy as well. Essentially, what you're looking at is whether the pivot is holding or not. Let's take a look at when you draw pivot points, depending on your trading platform, it may say PP, which will be your daily pivot, or it may say, so in this case, we'll mostly look at daily pivots. You can also have your weekly pivots and monthly pivots. However, at this point, we're only looking at your daily pivots. And we will also look at only standard way of calculating pivot points. Just like any kind of technical indicators, there are different ways of calculating these pivot points. There are like 3 or 4 different ways of calculating them. However, we will just use our standard way of calculating pivot points. And some of the terminology that you need to be aware of, again, PP stands for pivot point, or you may see something that says daily pivot, so that's the same thing. S stands for the support level, R stands for the resistance level, and then you'll also see S1, S2, S3, R1, R2, R3. Essentially, that is support 1, support 2, support 3, resistance 1, resistance 2, resistance 3. So let's take a look at how the pivot points are calculated. Basically, pivot points, and so anytime you see a pivot point, you will also see the support and resistance levels calculated for you. So you'll see pivot point, and then you will see S1, S2, S3, R1, R2, R3. So these will all be displayed. They're normally displayed with the pivot points when you actually put the pivot point indicator on your charts. So what you'll see is that it is calculated at a New York closing time of 4 p.m. Eastern time, or sometimes it's 5 p.m. Eastern time, depending on how your broker is calculating the pivot point. But it is usually calculated at the end of the New York closing time. You can check with your broker to see where they're calculating, and usually it may be a few pips off based on whether it's calculated at 4 p.m. or 5 p.m. or midnight. Some brokers will actually calculate the pivot point at midnight as well. So that's something you can find out when you get your indicator. Generally, there'll be some information to go with it that will say what type of clock they're using for calculating this. So the way you calculate pivot point, which is your PP, is they take the high and the low of the day. So high of the day, this is, again, we're talking about daily pivots. So they take the high of the day, they take the low of the day, and then they take the close of the day, where the price closed. And they, again, add that up, sum that up, and divide it by 3. So they're taking an average to calculate the daily pivot. So the high of the day, the low of the day, and the closing price, and you divide it by 3. So that's how your daily pivot is calculated. You may have a pivot point indicator, however, you may not know how it's calculated. So this is a really simple formula. There's really nothing complicated, just high of the day, low of the day, and the closing price divided by 3. And then to calculate your support and resistance areas, so the first resistance is twice the pivot point, so 2 times PP, and your first support area is 2 times the pivot point. So this is how you would calculate these two. And then S2 is pivot point plus high minus low, and support 2 will be pivot point minus high minus low. So it's just the difference of whether you're adding to or subtracting from. And the third level, R3 and S3, are calculated. So again, you have high plus 2 times pivot point minus low, and low minus 2 times high minus pivot points. Again, if these support and resistance area calculations sound a little bit complicated, don't worry about them. You never have to calculate them yourself. There are a lot of pivot point calculators everywhere. Most broker sites will have pivot point calculators on them. And the best part is you can actually get pivot point indicator. Just drop it on MT4 or whatever trade station you're using. Just drop it in there and it will do all these calculations for you. You don't have to do anything, any of these calculations. However, this is just for your understanding, so you know how they are calculated. Okay, so now let's take a look at how would you use pivot points. The first technique that we'll take a look at is around range-bound trading. So range-bound trading is essentially the price the market is trading between a high and a low. So there are 2 levels that are being held. So every time price goes to the high, it rejects that price and moves down. Every time it gets to that low support area, the price rejects that level and moves back into the range, within the range. And the price has just hard time going outside of that range, outside of that, the larger support and resistance area. So the way you would do this is you would look for your pivot point level. When the price goes to the pivot point will be in the middle. So you're looking for support 1, S1, R1, or S2, R2. So you're looking for these support and resistance areas, and you are looking to see whether that level holds or not. So let's say a market was going up. It's a range-bound market. The market is going up. So you'll be looking for, the first thing will be the R1. First resistance level, you will see if it holds. If the price holds, that would be a good place to sell with your stop above that level on the other side of that level. Then you'll be looking for a resistance to hold and the price to move down towards the middle of the range or the bottom of the range. And then the way you would pick your target would be you're either looking for it to go back to the daily pivot point or to go back to the S1 level. So those will be your targets. And then if the price goes through the S1, you're looking for it to go to S2 and then S3. So most often, S1 and R1 are the levels that are held most often. And sometimes the price will go to R2 and S2 levels. And if the swings are really wide, the price may go to R3 and S3. But what we have observed, most of the time, the price will go S2 pivot S1 pivot R1 or R1 pivot S1. So price kind of tends to behave like that, go from respects the S1 and R1 levels. If the price has a lot of momentum in the price, it will bounce to R2 and S2 levels and then may react at those levels. And sometimes if it's, we'll take a look at actually a live, Danny will share an example of where price actually went to R3 level as well, and how to identify if the price is going to hold or not. So when you're taking a trade in terms of a range-bound market, you draw your support and resistance levels where the range-bound market is, and then you're looking to trade the confluence. So let's look at an example. Here we have an example of a pound US dollar 15-minute chart. We have S1 here. This is the daily pivot. So it looks like price has crossed through the daily pivot and it's gone below the daily pivot and it's coming to S1. So what I suggest is do not trade pivot points on their own, just like any other technical indicators. I love looking for areas of confluence. And the reason you look for areas of confluence is because when a number of things line up at one level, that is a good option to trade at that level, because that level will most often, it will be a strong level and you will see price react at that level. That's why the more confluence, areas of confluence that you have coming together, for example, let's say you have your S1 level there, then you also have fib level, let's say 61.8, fib level sits in the same place, and you also have your manually drawn support and resistance area, for example. So you have three levels of three different things coming together at the same time, which is what I call an area of confluence. This will give you a higher probability trade because there are a number of things lining up at the same point, helping you take the trade. So look for areas of confluence when you're trading these pivots. So anytime you trade any kind of indicator, anything you trade, even price action, I look for areas of confluence even when trading price action. So it's a good idea to do that, even in this case. So in this example, for example, price is coming into S1, and I wouldn't suggest taking a trade right as the candle is red, because it could break down to the other side. It could go through this and hold on the other side of it. So what you want to do is wait for the candle to close, see how price reacts here. And once you start seeing rejection at this level, get into the trade. In this example, we would get into a trade to the long side, and we could place our support under the S2, or if the price is holding here, we can have a tighter stop right on the other side of S1. So these are two options of placing a trade right on the other side of S1 once you see that the price is holding this level, or if you wanted a wider stop, you can go on other side of S2 expecting that level to be held. So once the level is holding, you would get into the trade expecting the first target would be your daily pivot point. So this is where you would expect the price to go to. Because it's a range-bound market, we're expecting the price to reverse and go back to this one or the top of the range, which in this case will be the R1. So these will be your two potential targets that you will be aiming. And then depending on your trade management style, you can move your stops as the price comes to these levels, or you can take part of your profit off at the first target level and then the rest of it at the second target level. And that you can do, you can trade your style however you like to manage your trades. However, the important thing is you would wait for the price to hold here, and then you would target the price, this price or that price. All right, so we have another chart, and this is the same follow-up on the same chart. So here we saw a reversal pattern form here, and then the price held. So this would be, you could take a trade either in here or on the pullback, and see how the pullback has held here. The back test of this level has held. So you can take a trade in this area, somewhere in here, and you would expect the price to go up. So you could put your stop loss here, or if you wanted a wider one here, I recommend you can just put it in here because you're waiting for confirmation. You can put it right here, have a tighter stop, and you're expecting for the first profit target, which is a daily pivot, to be held. And here, as you can see, daily pivot held, and the price is starting trading below that. You can have whichever way you wanted to do this. If you're taking out part of your profits here, you'll be out of part of your trade, and then if you move your stop loss, your stop loss would get hit, and you would have some profit from there, and your first profit target would be held. But the point is using the pivot points and the R1 as your profit-taking areas. So that was the trading the range strategy. And if you were doing the opposite, so let's say the price was up here, you were trading the top of the range, so this was still a range, and the price was up here, you're looking to get into a short, so you wait for this type of pattern, some sort of reversal pattern on the top side here on R1. Once the R1 is holding, you could get into a sell trade, and you could put your stop just ahead of R1, and then you would target your daily pivot, or you would, the second target will be your support level here, S1. So that's how you would identify those targets in the range-bound market. Okay, now let's move on to how to trade breakouts using pivot points. So once the pivot point is broken, you are looking for, this is assuming it's not range, well, you can actually assume whether it's a range-bound market or not. So either way, once the pivot point is broken, you're looking to trade in the direction. So once the pivot point is broken, it gives you a direction for the trade. If the pivot point is being held, so let's say the price is moving up towards the pivot point, like we saw here, the price is moving from the bottom, it's moving up. So it's an upward bullish price movement. It's looking for the pivot point. If the price is holding holds below the pivot points, let's say if it goes and does something like this, that means the directional bias is to the downside. So there isn't enough strength in the price to go through this and break through to the upside. Now, in this strategy that we're talking about, we are talking about breakout points. In this case, the price is moving towards the daily pivot and it breaks through, let's say it's holding, and finally breaks through the daily pivot. And the market, so that means the market sentiment is to the upside now. It has shifted from being to the downside to going to the upside. So the more times the pivot holds, the stronger the sentiment in the market, that particular side, whether it's to the upside or to the downside, the more time it gets tested and holds, the stronger the market sentiment and stronger is the pivot level. So once it breaks, now how can you get into that particular trade? So again, we would look for the pivot, and when I talk about pivot, I don't mean just the daily pivot level. You can also look at R1. So R1, S1, R1, R2, S2, these are all important levels. So these are all pivot levels that are tied into the pivot. And those are the levels we'll be looking at. So it won't just be, the trade won't just only set up at the daily pivot level. It could also set up at R1 or S1, R2, S2. All of these levels are valid and they all act as support and resistance points. So in this case, we are looking for pivot to be broken, and then we are looking for a back test of that level to take a trade. And in terms of our profit targets, if we are going to the upside, we'll be going to R1, R2, and R3. We'll be looking at all of these for our potential targets. If we are in a bearish move, we'll be looking for S1, S2, or S3 as the potential targets for that breakout move. And again, we would place our stop if the price is reacting at the pivot level. We would place our stop on the other side of the pivot, or if it's at R1, we'll place our stop on the other side of R1, looking for a move to the downside. And again, targeting the daily pivot, then S1, S2, S3. And if it's a bullish, we'll place our stop on other side of the pivot, for example, then look for these levels. One important thing I would make a note of is staying away from news. The market tends to get too volatile when it comes to news, and we may see exaggerated moves at time of the news. So our pivots, or actually any kind of technical levels, could get blown out during this time of high volatility. What I've seen a lot of times is the price will move one way, take out the stops, and then turn around and move the other way, take out the stops. And once the entire board's been cleared, then the price will find its way through the market. So just be aware of that and note that during news, everything's fair game. Whatever type of technical indicator you have is essentially, it may not work not because the technical indicators won't work or don't work, but because there is high level of volatility in the market, and also there's usually a low level of liquidity. And by that, I mean that a lot of traders would have taken their orders out of the market so that when the price moves, it will jump to whatever level it can find the order block. And so price will go look for these order blocks. And because there's nothing in the way, it's like doing a free fall. When you throw an object, it will just come and hit the ground wherever it can find that level of that order block to provide support and resistance. That's where the price will come to. And then as it trades at that level, and it could continue on. So it's better to just kind of stay away from the news when using these technical indicators, because they may not hold. And again, look for the areas of confluence for taking best trades, which means if you have your manually drawn support and resistance in that level, for example, if you're using any kind of indicator, your moving averages or anything else, let's say if your moving averages are crossing at that point, or you have drawn your Fibonacci levels and they are coming together at that point. So look for those areas of confluence, and you will find those areas of confluence where your different indicators are coming together. Those will be the places where you will see the best trades. So actually at this point, Danny, do you want to share your screen? We had a really nice setup that happened last week in this it was the euro dollar move. So Danny, can you share your screen and show us that chart, please?
Yes, just 1 second. Good morning, everyone. Good morning. Just before I start looking into and dissecting this chart, let me just thank Raman quickly for having me part of the webinar. I am one of her mentorship students, and it's truly an honor to actually work along the side of your teacher. So thank you for that. And before I look into this, let me give you a bit of a background on my Forex trading experience. Actually, prior to taking Raman's course, I had very little to no trading experience in the Forex at all. I had traded a demo account for about a month or so, slowly transitioned into live trading. However, I quickly realized that I had no concrete approach or any strategies or methods to my trading and executing of my trades. So I knew I needed to get a professional opinion, a person to actually guide me through this process. And from a student point of view, once I took Raman's trading course, my entire perspective to trading changed. Now, words can only say so much here, but basically the course was such a success that I decided to take Raman as my private mentor, my one-on-one coach. And just to give you a bit of a breakdown of how we do this, we meet basically on a daily basis and analyze the markets and dissect what the price did. Basically, we need to know what the price did to know where the price is going. And Raman's approach to this is just priceless to me. I've learned so much, and we've only been together full time for about just over 2 months. I've put in roughly over 300 hours with the charts with her. So basically, let's just break this down a little bit more and just say how we do this in case someone's interested in pursuing this career a bit more. We basically meet on a daily basis. She will coach me through my trades. We will analyze the markets. We'll do post-market analysis. We'll do our daily market analysis and our technicals and fundamentals. And guys, what I'm about to tell you right now is very important here. These aspects of trading, of being successful, need to be done on a daily basis. And I'm myself guilty of shortcutting this. I've tried to shortcut it, and it reflects in your trades. You really need to do these. And the most importantly, you need to do these correctly. That's the key word here, is correctly. And Raman's way of teaching these strategies is absolutely amazing. Like I said, words can only say so much, but she is a real expert in this, and I've only been with her for 2 months. I feel like I've been learning for years of how much information I've gathered over time, and I appreciate it very much what she does, how she looks at the markets. I trust her 100% with the way things are going. So that's just a bit of a background on how I'm doing as far as being her student. And if anyone is interested, definitely don't second guess yourself. It's the way to go. And I'll show you a little bit now of what I mean by looking at this chart here. So that's enough about me. And let's take a look at this euro dollar chart we have here on the screen. You will see 3 different dates we're looking at: September 9th, September 10th, and September 11th. I picked the euro dollar chart. We're looking at into a 15-minute time frame on an MT4 platform. And you can see our dividers here are these white dotted lines. So some of the information I actually go through here might seem obvious and repetitive, but I'd like for everyone to be on the same page and sort of see how simple this is, yet how complicated we can sometimes make it. So let's look here and notice this green line. That will be our daily pivot point for September 9th. You'll notice 3 red lines on top, marked R1, R2, and R3. These 3 are our resistance levels. And at the bottom, these dark blue lines are S1s, S2, and S3s. However, at this point, you can't see the S2 and S3 because we're analyzing the Rs. So the market is in the uptrend at this point. So hopefully everyone so far is on the same page here. And why I picked a 15-minute time frame is because we can simply see the price action very clearly. These pivot levels do transfer through your other time frames, depending on what your preference is. However, I find this to be a very good time frame to see what the price has done, what the price is currently doing. So if we start down here on September 9th, we can see a nice move up in the euro here. And we can see the price approaching the daily pivot. Now, if you're long in this entry, you would definitely be looking at the price action in this area to see how the price is reacting for your potential take profit levels. And you can see the price does hesitate in this level, so there are some orders in this area. So it would definitely be a good place to take your profits, or at least watch the price reaction before it continues. So let's move on. And we'll notice the price go into the New York close, and this is where the price closes as it's marked here, a day close. Now, let's pretend that we don't see any of these candles from here on, and we're just seeing, we just open our trade stations, and we're looking at the Asian Open. So if you were to pay attention to your levels, your R1 and your R2 levels, they will already be pre-marked on your charts, just like so. So as if you were to be long in this trade here, you would potentially look for the next take profit level or the next level where the price may react. Basically, we can see here, this next R1 level here is being respected very nicely by this price. And if you were long in this trade, you're potentially looking at a 40 pip take profit level. Now, once the price pierces through the level, you can see the candle close right below the level. Now you're interested in actually watching what's happening here at this level, and you're noticing the price is actually having trouble going further. And you can see the price hesitates here for about three 15-minute candles. before it bounces off and goes back into the level, basically touching it to the pip. Now, we can see that this level is being respected multiple times. The price retraces all the way down, and here's the key thing. You could have actually been watching the price at this level, depending on what session you like to trade. And by watching what the price is doing, you could have been on this trade as well, going the opposite way for potentially another 40 pips or so. Now let's look at a key point right here. You can see the price retrace, and you can see a strong wick into this level here. And now we may wonder, well, the daily pivot is down here. What is the significance really of this wick? Well, this is the best part about pivot points. Let's look to our left and extend this line and see what this line was. This was our daily or previous day pivot point. So you can see that the respect that these pivot points are getting. So this could potentially be your take profit level, or you can definitely just watch the price, observe it, and notice what happened at this point. Not looking at this point here at all for now, just seeing why the price potentially reversed off this level is because this was our previous daily pivot. Now, as the price bounces off, you can see the price goes back into R1, couple pips away from it, yet there's another level it's respecting once again. Now the price finally retraces back into our today's daily pivot. Everyone can see this green line right here is today's daily pivot. And here's another example of what Raman mentioned about not taking trades blindly on these pivot points, because we do see the price does struggle at this level. It's unable to break the level, but however pulls back into the level again, piercing it roughly 14 pips below. Now, if you were trading the pivot points standalone, you would have your buy order potentially here on the line. And if you were to have a very tight stop loss, look what would have happened. Okay, that's a very good example of not trading these blindly, because, you know, if you were away from your trade station, you'd come in and see what happened, what the price did, and possibly pull some of your hair out at this point if your stop loss was way too tight. So looking back at this level here for reversal and looking back at the price action at this point, this is a sort of, I call it a Kodak moment. This is an amazing setup for a potential long. Now, Raman's course actually breaks this down a lot. She really dissects what happens in this case. How do you identify these setups? So remember what she was mentioning about Confluence. Basically, multiple factors coming together for a high probability trade. See, this is where, once we have multiple factors coming in of how identifying this particular setup or what the price does here on a smaller time frame, you can identify reversals to go with the trend. So basically, remember, multiple factors coming together to form high probability trades. This is where the word gamble exits trading, and we feel more confident in taking these trades. And simply, if you look what happens here, if you were to go long at this position, you can see this after this green candle close, we could potentially enter here. Entry long at this level is a very important level. We could either enter at this level or potentially wait for a little bit of a back test and enter over here to go long. Again, we go back into our R1. Now we can see this green candle break through with momentum and close above our daily R1, which was also our previous day R1. So you see how we have multiple things coming together here? And once you were to see this candle break through, you could potentially see this as your take profit level if you enter the trade down here. And you can see right here, you're looking at potentially 45 pips. So just simply looking at these levels, we can see how well they work together. But we also need to watch the price react at these levels to see how we can enter trades. Just because we see these wicks here doesn't mean that we should go long immediately, because look what can potentially happen, right? So everyone is on the same page so far. So if you were to see this candle break through this level and you were still in the trade, you could potentially now look into your R2 level as a take profit, and you can see how the price nicely breaks through and reacts. This would be a great time to take profit if you were long here, if you didn't want to take any chances of what might happen next. You're happy with your 45, 50, 60 pips. You'll be good to exit the trade here. And now let's see how R2 gets respected here. The price actually doesn't move below. It kind of stalls at this R2 level, breaks through, and it continues into the New York close one more time. And we can see right here the great amount of respect we get. The price does not break through R2. It actually slowly closes into it and bounces off. Now again, we just noticed, based on all these levels, all these times, how much has price actually respected these levels. Now I hope you guys can see how simple this is. Sometimes we do overcomplicate it by looking into too many factors at once. So just simply taking it little by little, we can see what the price is doing. And like I mentioned, Raman's course breaks this down into great detail. It might sound simple right now. There's a little bit more to it, but identifying these trades, once you learn how to do that in Confluence with your pivots, you're golden. So basically, let's just kind of bring this into conclusion and see what's happening here. If you were to trade the next day again, pay attention to the price at these levels and what your bias is for the next day. And again, this is where your technical and fundamental analysis come in. This is where your post-market review comes in. From my point of view, again, as a student, I've noticed our post-market reviews are the most important reviews you can do on the markets. If you know what happened, if you can use your Confluence, you can easily project what the price might do in the future. Being aware of the news, large market movements is definitely a must, but based on what we see so far, we can see how these levels get respected. So, like I mentioned, if anyone is ever interested in pursuing the course, you guys can learn this in great detail. You can sit in with us and see how we do this day in and day out. And basically, how you get confident is when you wake up in the morning, all you need to do is, glance at the market, and within the first 5 seconds, you should already know where the market is, what the market did previously, where the market might go. It shouldn't take very long, but in order to get that good, you need to do your post-market reviews. You need to be able to draw the market, the price action in your mind. Before you even see what's going to happen, you need to know what the price did. And once you get into a habit of doing this over and over and over, you will see how simple this really is. And if we just kind of conclude here and see how the price is actually doing, the price stays above the R2 into the Asian session, into the London session, and then you can see here how it breaks through. Even if you're looking at this level and you don't see any lines, you don't see any pivot points, this is the best thing about the pivot points, look back and see what happened previously and why this is happening and why did this happen. And it's a perfect backtest of this R2. You can see that right here. The price blows through, comes back and tests the R2 once again. So we've just looked over 3 days of market data. These charts weren't formulated in any way to actually fit this. It's basically what the price has told us is what we're working with. And that's how we would basically look into these pivot points from a very, very simple point of view. And guys, I highly, highly do, if you want to be profitable in this business, you need an expert's point of view at this. You can spend time over time learning this on your own. If you don't know how to do it properly, you will create bad habits. I guarantee you that from a student's point of view. I've done it over and over and over. So basically, I encourage everyone to mark your charts like this. It takes time, but mark them. As you're marking them, you will understand them better and better. You're going to be sort of emotionally attached to what's actually happening in the market. And that will definitely contribute to your success, 100%. Thanks for listening, and I will turn the market back over to Raman.
Thanks, Danny, for explaining the chart to us and for your kind words. I was blushing a little bit. But thank you. And actually, let's take a look at another example. This is from last week. As you can see, this was actually a great trading opportunity for a mentor. It's a proud moment when your students can identify these things that you teach them and mark them up. So this is a trade setup that we actually took. This is actually the few different ones. These are over a few different days here. Let me just show you. So this is what happened. This is current price action last week. Again, this is really nothing that has been changed in any way. I didn't go to a different year to find the charts. This is just your normal last week price action. So here, as we can see on September the 10th, we had a pivot point. See how there are multiple pins into this level. So this is the pivot point that was respected. As you can see, price pushed off of this level to go upwards, and then the price continued on. So somebody's asking me, give me an example of where the pivot points don't work. And when I say don't use pivot points blindly, I 100% mean that. What I would like to do is not just put a trade here because I expect the price, let's say price is coming down here. I wouldn't say the price will turn at this pivot point because I don't know. I'm a price action trader first. I'm a technical, I'm actually not a big indicator trader. First thing that I do, and I like to teach everyone, is look at naked chart, nothing on the charts, and then you manually with your hand, I'm kind of old fashioned that way, draw your support and resistance areas. So I am very much in favor of, as you can see, there are no other technical indicators here, just your support and resistance lines, and then there are the pivot points essentially. So I would say, don't just enter a trade, don't enter a buy order here because the price is coming down towards the pivot point, because at this point, while the price, we don't know what happened here. So let's say we don't know what happened. Let's say this did not exist. It was real life price action. Because we don't know what's going to happen, nobody can predict the future. We don't know if this pivot point would hold. It could just as easily pierce through this pivot point and go to the other side and start trading, start going lower. However, that's why we have to watch price action in this area. And it's even better if there is support and resistance in this. There's a particular level here, your support and resistance level or fib level or something else that lines up with it. That will give you a high probability setup or high probability area where you will see price react. So wait for the price to show you what the price will do. And once you start seeing all these pins into this level, that's when you know the level is going to hold, especially when you see a stop run in this area. See how this line pierces through this area? That's usually a stop run. So price is getting pushed down. There are usually a bunch of stops right here, and price will just run the stops, kind of clear the board here, and starts holding above. So once you see the price being held above, then you enter the trade, like somewhere in here, or as the price is pulling back here, then you enter this price long. And here, as you can see, the price rejects this R2 level. This is R1, this is R2. Price rejects this R2 level. And this is an example of where pivot points may not work, because if you entered a trade short at this point, and that's why I recommend taking some of your profits at these levels, because if you entered a prop short here, because see, rejection, and you entered a short here, it would not work. It would not work. Your short did not work. So this is an example of where it does not work, right? Now, once the price starts holding above, it comes and does a back test of it, and then the price continue. But as you can see, over the long term, goes from pivot, goes right through R1, goes to R2, has problem at R2, comes back and tests closer to the daily pivot here, and then pushes off. So anyways, as you can see, the price has reacted. See how price held below this daily pivot, which gives us the market sentiment, which tells us that today, on this particular day, September 15, the market sentiment is to the downside. It's just not able to hold above the daily pivot. The price rejects this. I was actually in this trade at in the bottom here. I got in and I got out here as I saw that this level wasn't holding. And as you can see, the price came down. And again, see, R2 acted as a nice pin into this R2 level. Very nice way to show, it's showing that it's rejected this level. And as you can see, price traded back up, came right to R1 and shows rejection at that level. So as you can see, these levels are your potential profit taking. If you're entering a trade at R2 here, the first one would be S1, then your daily pivot, then R1. So these yellow lines are just support and resistance lines that have been drawn by hand. So these are nothing special, just kind of marking the potential support and resistance areas. And really what you're looking for is confluence. For example, this one here, this was a level where price had reacted before. And here, as you can see, it was just a support and resistance line. And it also lines up with your support and resistance here. This is the R1 level. This is the daily pivot and the S1. So as you can see, two different things coming together. That's what I call confluence. And this is actually an example that I'm going to show you of a trend type of trade, which we'll cover in the next slide here. So price comes and rejects. So yesterday the price was moving up, finally comes to this R1 level here, rejects, and comes and hits this support level again and bounces off of that. This is 1299, so 1300 level, which is an important level. Just the zero levels are in support and resistance price action terms are important levels. So these are important. This is a important support and resistance level. It was resistance here, support, resistance. So what we find is support will become resistance, which will become support again. So this level is acting as support. It was acting as resistance here, and now is acting as support. And once the price holds above this, it goes and it blasts through here through our R1 level. And now let's say the trade was up here, so price was up here, and you were looking for a way to, the momentum is to the upside now. And another thing to keep in mind here was this is when a market expected the Fed to not raise interest rates. There was only a 30% chance that they would raise interest rates. So prior to that meeting there, then that's why it came out that they did not raise interest rates, of course. So let's say you wanted to get into this trade. A good way to get into this trade would be looking at this level here. See how price held, this level held for quite some time, and then it broke through. Finally, price broke through. And then you're looking for the back test of this level. This is one of the strategies I teach in, even outside of the pivot points, I teach in the course. So this is a back test of the level trade, what I call the back test of the level trade. This is a previous support and resistance line that we have drawn, that we have seen that the price has respected previously. And finally, the momentum carries through, market sentiment has changed. Price comes and does a back test of this level. We can enter the trade here. And as you can see, it does a back test of R2 again, and then goes right to R3. This is when the market had strong momentum. This is a very nice momentum trade, and this can be taken in. And look how nicely it reacts off of the pivot points. It gives you those entries off of the pivot points. Again, I suggest using this with Confluence, for example, two different things coming together here. But this is a very nice continuation pattern where the market momentum is to the upside. We also had another trade. So this is on the 18th. On the downside here as well. Once this yesterday, so previous day highs and lows are very important as well. So as you can see, this level here, this R3, which is in confluence with this is previous day's high and R3. And it is also an important support and resistance level from previously. If you look at a 4-hour chart, this is actually a support, a very important support and resistance area. See how it came, broke through, and came and tested the backside of it. This is where we took a trade. And actually, Friday was a really profitable day. There was both pound and euro dollar had very nice on actually pound. I think it was a pivot point. Both of them reacted off of the support and resistance, and there was multiple levels of confluence coming together and gave us a very nice trade. As you all know, price came down after all the hype was over about the interest rates. Price came down and dropped, and that's what we were looking for as well. Anytime you see a big push up based on sentiments, people get talk, all this hype, price moves up on hype, you will see the price coming down. It was also Friday, a lot of people closing up their trades. Big financial institutions will be closing up their trades, booking their profits for the week. And it was also an options expiry day as well. So all of those three factors coming together, plus with our technicals lining up with this kind of, so this was a nice trade off of this level. right into these levels, daily pivot and below. So I can't remember where the price closed, but we had very nice trades both in the pound and the euro out of this. This is the euro. So as you can see, this is multiple days, fairly recent price action. So this is nothing doctored. There's nothing even on this chart. So this is just some examples of how price tends to react at these levels and how to trade them. So let's go back into our seminar here and let's take a look at, so market sentiment, we just talked about how if the price breaks through the pivot point, then you take a trade, you look for the back test of that level and to get into the trade. So this is how where the price is holding in regards to the pivot point usually gives you the sentiment for the day as to where the next price move may come to be. Here, for example, here the price respects the pivot point, and you expect the price to kind of stay on this side. Once the price gets on the other side of the pivot point, you would expect the price to move up on that side. All right, so other than that, so just in review, I would say Forex traders use pivot levels. I know the big financial institutions use pivot levels, and because they use them, they end up being just like Fibonacci levels. They end up being one of those self-fulfilling prophecies because traders tend to place orders around them. So usually there are order blocks around these levels. And because of that, because everybody believes them, it's like one of those things when everybody believes them, it ends up coming true because you actually believe it. And they are one of these levels. Again, they're objective level. When you draw Fibonacci levels, you can use whatever swing high and low that you choose. However, in this case, there's only one day close, for example, one high of the day, one low of the day. Those numbers aren't really they're not subjective. They're very objective numbers. They don't change. So that's why it's an objective way of looking at potential support and resistance areas. And you can use them, again, for range trading, for breakout trades, and also for trend, for staying within the trend for your trades. Again, last thing I would say is look for areas of confluence for best trade setups. Just because a daily pivot is there doesn't mean that that level will hold. Look for the price action in this area, and especially if you have, for example, 61.8 Fibonacci level at that level, or you have 78.9 Fibonacci levels. I love the 78.9 Fibonacci levels. If that comes in and there's previous support and resistance in that area, all of those factors coming together to create that confluence just makes it a higher probability trade. So just because you identify an area as a high potential, high probability trade area, do not enter it blindly. Watch the price action in that area. And once you see that the level is holding, that's a good time to enter the trade.